Here's something that people don't talk about enough in the small business buying community. You can still buy a great company and make a huge mistake by overpaying for the purchase of that company. In this video, I'm going to go through 10 ways that a seller can trick you into overpaying for their business. The first way that a seller can trick you is by adding back 100% of their salary to SDE when they're working more than full-time in the business. If you have an owner in a company that's routinely working 60, 70 plus hours in their business, and then you're stepping in to fill those shoes, it's very reasonable to expect that you're going to have to hire at least one, maybe two people along with yourself in order to replace them. Therefore, when you're calculating a normal level of SDE, you need to be accounting for those additional salaries that you're going to be incurring. The second way you'll see sellers frequently inflate their earnings is by not properly normalizing for rent. What you'll find is that very frequently, small business owners will purchase the building that they operate out of, then they'll have to rent to themselves. When they do that rent payment, they might not be doing that rent at fair market value. Or sometimes what you'll find is that the seller is adding back 100% of rent because they're paying it to themselves, not accounting for the fact that you need to include a fair market rent on the business, otherwise it's just being subsidized by the landlord. So make sure you're properly normalizing for rent when you're valuing a small business. The third way that you'll see sellers inflate the value of their business is by applying an EBITDA multiple to their SDE. This is one that anyone who's looked at BizBuySell has probably run into. When calculating SDE, you're going to add back costs to pay the owner of the business as well as all of the perks that you're going to pay the owner. Versus when you're calculating EBITDA, you're going to include all of those costs in your calculation. Therefore, the typical multiple you're going to see for EBITDA is going to be higher than the multiple you're going to see for SDE. So you have to be really careful to make sure that a seller isn't applying a market EBITDA multiple to their SDE figure in order to inflate the value of their company. The fourth way that you'll see sellers inflate the value of their business is by not properly accounting for family members who are working in the business who are way underpaid or not being paid at all. The classic example of this is a spouse who mainly works in the office, is doing a lot of the bookkeeping, but has a salary that is way below market rate. Maybe they're getting paid a few $1,000s a month or not getting paid at all. Meanwhile, they're the person that does all the admin work and keeps the finances running in the business. When you come in to acquire this company, you're no longer going to have that perk, and you're going to have to either outsource or hire someone full-time to replace that person, and you need to be accounting for that person's salary when you're calculating SDE or EBITDA. The fifth way that you'll see sellers inflate the value of their company is by using bogus add-backs. A bogus add-back is something that a seller is claiming that a buyer won't need to be paying going forward, such as a potential owner benefit or perk. However, it's something that can't be proven and is not easily identifiable and usually has already been deducted on the person's taxes. Some good examples of this are going to be when the seller is estimating how much they're spending personally for meals when they also spend a lot of money on meals for the team and travel for the team. You also see this pretty frequently with vehicle expenses where the owner has a truck that they use for business, but they also use for personal, and they're trying to take some allocation that's really just an estimate of how much they're using for personal expenses when it really cannot be proven. The sixth way that you'll see sellers overvalue their business is by using projections rather than actual results when they're determining how much EBITDA or SDE their business is producing. So if you're buying a small business, typically under, let's say, $10 million in enterprise value, as a general rule of thumb, these companies should be valued based off of the actual results that they've been producing. With much larger companies or like a venture-backed startup, it might be much more typical to use a discounted cash flows model in order to value the business because you're really valuing it off of what it could be doing in the future versus what it's doing today. However, with Main Street businesses, typical electrical, plumbing, HVAC companies, these businesses should be valued based off what they've actually done historically, not what they could potentially do in the future. The seventh way that you'll see sellers overvalue their businesses is by propping up the last year's results of their company artificially. Some ways you might see sellers do this is by pulling revenue into the most recent year from a prior year, or pulling revenue into this year that should be in next year and putting it into the current year. Another way that you might see them do this is by pushing expenses into a prior year or delaying expenses into a future year in order to keep those expenses out of the most current year that they're trying to make you pay for a multiple based off of. Another way you'll see this done is when a business doesn't track their inventory very well, and they may have built up a large balance of inventory in prior years, but not adjusted that on their balance sheet. So then all those expenses are sitting in a prior year, and then as they use that inventory in the current year, you're seeing underreported expenses. The eighth way you'll see sellers overvalue their companies is by using a multiple on those businesses that is way too high. Most small businesses are going to trade for somewhere between 2 and 5 times their earnings. And businesses that are trading on the higher end of that range or even above it, they generally should have characteristics worthy of trading at that higher range. So it's going to be really sticky revenue, good management layer in place, processes that are documented, while businesses that don't have any of that really should trade at a much lower multiple. That being said, with the growing popularity of small business transactions, there are some sellers out there that don't have any of those good characteristics that are trying to cherry pick the valuations of businesses that do have those characteristics and apply that multiple to their inferior company. The ninth way that you'll see sellers overvalue their companies is by not accounting for capital expenditures when they're valuing the business. This is going to be particularly common with businesses with a large fleet of vehicles or a lot of heavy equipment. If you're buying one of those businesses, you want to be very cognizant of, has this equipment been regularly maintained and replaced? Or are you buying a company where the seller has not invested in the upkeep of their fleet, and now you're coming in with a lot of deferred maintenance that ultimately is going to greatly reduce the amount of cash flow you're going to have in the early years as you work to replace and upkeep all of that equipment. The 10th way that you'll see sellers overvalue their companies is by trying to add bad expenses as one-time that are actually not one-time in nature. You can see examples of this hidden in many places on the P&L. Some of the most common ones that I've seen are bad debt expense. Their sellers saying won't recur in the future, but is just commonplace in most small businesses, and you're also seeing it pop up every year in the business. Another place you might see this is in repairs and maintenance, where there's been some routine repair that's been done to the company that, yes, maybe that repair is going to have to be done for another 5 or 10 years, but repairs are a commonplace across the company, and there's probably going to be another repair that will pop up next year instead of that one. Yeah. One final place you might see this is in marketing expenses. They're adding back a marketing expense that they say was a failed marketing expense, but as we all know in business, failing at a particular marketing campaign is just par for the course. It happens all the time and is going to be a routine part of your company going forward. I want to hear from you. Have you seen examples of these pop up in deals that you looked at? Or are there any big ones that you think I missed? Let me know in the comments below.